if a company wants to raise money and they don't want to give away ownership, they have this other option of issuing a bond. What this does is that it borrows money from the public. So, for example, this is a McDonald's bond for $1,000, which means McDonald's is wanting to borrow $1,000 from the public, and in exchange, they're going to pay back interest at 4 1/4%. So what they're going to do is, at the end of 10 years, they're going to pay back the $1,000, and every 6 months, they're going to pay them 4 1/4% interest. So that's what a bond is. So once you have issued a bond, you've got a contract here. You've written on the bond what you promise. McDonald's is promising to pay back $1,000 as well as paying the 4 1/4 interest rate. So that is the contract that you have made. We're going to call that the contract rate, because no matter what, McDonald's is going to pay every 6 months the 4 1/4 interest rate. And what that means is they're going to pay 4 1/4% times 1/2, because the reason I say 1/2 is this is an annualized interest rate, and we're going to pay it twice a year. So 4 1/4 times 1/2. And then at the end of the term, the end of the 10 years, they're going to pay back that $1,000. So that's our contract rate. Now, if the interest in the market is the same, this is going to be easy to calculate. So if the contract rate is equal to the market rate, that means you could go out and get a bond in the market at 4 1/4%, then this bond will be sold at face value. That means it just sold for the $1,000. And the way you'll see that in accounting is it was sold at 1, or it was sold at 100%. So you would say the 1,000 times 1 or times 100%, and that will give you the $1,000. Someone would give you $1,000 and you would pay interest for 10 years, and at the end of the 10 years you would give them back the $1,000. That is very easy to account for. However, market interest rates change daily for a variety of reasons. For example, supply and demand, the contraction of money supply, the Federal Reserve changing interest rates to stimulate the economy. So all these things change our interest rates. So they're rarely exactly the same as what was printed on the bond. So we still pay the same amount every 6 months, but we tweak the price up front. Here's what I mean. If the contract rate is less than the market rate, that is, if you could go out into the market and get more money, would you want a McDonald's bond that's paying 4 1/4% if you could go out into the market and get a bond that's paying, let's say, 10%? No, this wouldn't be very attractive to you. So in order to sell it, they have to discount it. So we call that a discount. That is, if the contract is less than what you could get at the market, it's sold at a discount. And the way you would see that is it would be less than 100% or less than 1. So let's say, for example, it was 0.97%. Then I would sell this bond for $970. These calculations are done to arrive exactly at the same answer as what would have happened if this bond would have been paid at market interest rate. We're not actually going to do that calculation. That calculation is actually done through present value tables, future value tables, but just know when we arrive at this 97, It was the exact calculation to give the bondholder exactly market interest rate. Okay, let's look at the third example, contract rate greater than market rate. Under this last scenario, this bond becomes very attractive. Now bondholders can get 4 1/4%, but in the market, they can get only less than that. But McDonald's is not going to sell it to us unless they can true it up or down to the market rate. And in order to do that, they're actually going to have to sell it at a premium, which is anything greater than 100%. So let's say this was issued at 104. The bondholder would have to pay $1,040. So what's important to note is, as far as the corporation and as far as the bondholder goes, it doesn't matter if it's sold at face value, a discount, or a premium, because regardless, you are always going to get the market value, the market interest rate at the end of the day. So this explains bonds and the different types of bonds at face value, discount, and premium. Let me know if you have any questions.